the end year adjustments. So when we were doing the ledger accounts, we used to prepare those ledger accounts, balance them, and then we use those balances in extracting what we call the trial balance. We used to prepare the ledger accounts, those key accounts, we balance them. Then the balance brought down, we used to prepare the trial balance. The accounting cycle requires that the trial balance should be used to prepare the final account. The trial balance will have the debit balances and the credit balances. If you can recall, we said that all the expenses will have the debit balance. So we have something like salary, maybe its balance was 12,000, it will appear on the debit. Something like insurance will be on the debit, maybe it is 9,000. And then all the incomes or revenues, they normally have the credit balance, something like the rent income, maybe it is 15,000, it will be on the credit because incomes will always have the credit balance. It can be commission received, commission receivable, maybe it is 7,000, it will be on the credit, and many others. The capital will be on the credit, the sales on the credit, and all that. Once you have prepared your trial balance, then the accountant is supposed to use these balances in the trial balance to prepare what we call the final accounts. They are normally prepared using these balances. And when we are talking about the final accounts, we are going to be talking about the income statement. Those who have been in a business class, maybe in high school, we used to call it the trading profit and loss account. The income statement, trading profit and loss account. The other final account that we shall be preparing, it is the statement of financial position. Those are the two final accounts that we shall be dealing with majorly. Though we have the others, like the cash flow statement, the statement of changes in equity, and many other, which in this case, we are not going to deal with them so much. But these two, we are going to deal with them predominantly, especially the next like 2 or 3 topics, we will be talking about this. So, this statement, the income statement, the purpose of preparing this income statement is for us to be able to know how much revenue did we raise, how much cost or expenses did we incur, and therefore, what is our profit? If we take all the income that we generated, we deduct all the expenses or the cost incurred in running the business, how much profit or loss did we make in that period of 12 months? That is the purpose of the income statement, to measure the performance of the business in terms of profitability. We compare the incomes and the expenditures or the costs, and then we can be able to know either the profit or loss the business made in that period of 12 months. The next statement is the statement of financial position, whose purpose is to measure actually our financial position. If we take all our assets that we have, we deduct all the liabilities, what will be our net worth? What will be our net worth? So when you hear people saying that the net worth of a person, it is simply all the assets that he owns. You deduct all the liabilities. What remains is the net worth of that person. The same case can be applied in business. All the assets the business owns, deduct all the liabilities, you get your net worth, and that is your financial position. Those two statements are prepared using these balances, which is a summary of all the transactions that occurred in the business in that period of 12 months. And then we can be able to measure the business in terms of profitability, in terms of financial position. Now, when we are talking about the end year adjustments here, we are simply saying that some of the balances that are reflected on the trial balance, some of them might require adjustments to be made on them at the end of the financial year. We are going to witness that when the year has come to an end, either something has not been received or something has not been paid, or there is an amount that is supposed to be deducted from a particular item and all that. So those are the adjustments that we are going to make on the balances that are on the trial balance and what we are talking about as the end year adjustment, and that is what we are going to be discussing this morning. So the end year adjustments are grouped into four. We are going to discuss about number one is what we call the accruals. The accruals. And when we talk about accruals, it is simply the amount of money the business has either not paid or the business has not yet received by the end of the financial year. The business has not either paid that amount or it has not yet received that amount of money by the end of a financial year. Remember, a financial year is a period of 12 months. So we started here maybe probably January, we are ending at December. So this is normally what we call the financial year, 12 months. So when we come to the end of the financial year, probably there is an excess amount that we have not paid. Maybe, for example, the salaries. There is an amount that we have not paid, maybe for the salaries of that last month of December. Or there is an income that we have not received, probably maybe from rent. By the end of that financial year, that amount not yet paid or received is said to be accrued, and we call those accruals. And that basis, because it is either amount not yet received or not yet paid, we are going to have accruals categorized into two. A, we have what we call the accrued expenses. The accruals not paid or received. So amount not yet paid by the end of the financial year is said to be accrued expenses, because expenses we pay. And if there is any amount for a particular expense not yet paid, it is going to be considered as an accrued expense amount. Number two, or B, is what we call the accrued income or incomes. This is an income amount which by the end of the financial year we have not received. We have earned that income but not yet received. So the question now is, when we have accruals in a question or in a business, how are we supposed to deal with? To deal with accruals, whether it is accrued expense or accrued income, you normally go and add to the amount in trial balance. You add it to the amount in the trial balance. So like, for example, you will be given a summary of the trial balance like this. This is just for our illustration. I know the trial balance will have many things. But then, after this, you will be given what we call additional information. Additional information on the notes, whereby they will tell you accrued salary was maybe 5,000 as at 31st of December, maybe it was 2022. The accrued salary was 5,000. So what you do, you treat that amount as follows. Remember, in the trial balance, you have a salary of 12. This is what was paid. Yeah? And then 5,000, if it is accrued, it has not been paid. The point is, when you are preparing this statement, we call the income statement, we normally prepare it on an accrual basis. Meaning that we normally use the total amount that was supposed to be received or that was supposed to be paid that year. We don't use what was paid and what was received. We use what was supposed to be paid or what was supposed to be received in that financial year. Even if the amount of money has not been received or paid, we must include it. So when we shall be listing our expenses and we come to the expense by the name salary, we cannot use 12,000. We are going to use 12,000 that was paid plus 5,000 that is accrued. So in that financial year, the salary expense was 17,000, and that is what we are going to use or to capture in our income statement. We are going to use the amount that was supposed to be paid, not what was paid. What was supposed to be paid is what we use, so that now we can be able to get a true and correct picture about the performance of our business. Otherwise, this 5,000 not yet paid by the end of that year, if we treat it in the next financial year, then we are going to be lying to ourselves, because that money was not incurred in 2023. It was incurred in 2022. So it should be treated in the financial year where it occurred. And that is what the principle of accrual talks about. Expenses and revenues should be recorded in the financial year they occurred, not when the money is paid or received. So we add it. You add it. So any accrued amount, you add it to the amount already paid to get the exact amount that was supposed to be paid. The same case applies to the accrued income. So for example, here we have the rent income. The rent income here is 15,000. Then you can be told that accrued rent income was 2,000. So when you are going to be listing the incomes, then the rent income should not be 15,000, should be 15,000 plus that 2,000 that is yet to be received. The total income from rent from that period is 17,000. So accruals you add. Then the other thing that you need to note, that is as far as the income statement is concerned. For the income statement, when you're recording the expense, because the income statement simply deals with incomes and expenses or costs incurred, nothing more. Incomes and costs that were incurred, they prepare this. Then, statement of financial position, we normally prepare by using assets, capital, and liabilities. Assets, capital, and liabilities, we use them to prepare the statement of financial position. Then you will agree with me. This accrued expense, remember it is not yet paid. So from the business point of view, this one should be treated as a liability. That one should be treated as a liability because it's an amount that we have not paid. And anything that we owe somebody or a third party is considered to be a liability. So this one is a liability. Accrued income, because it is an income that is not yet received, and it is our income already because we have earned it, it is going to be treated in this statement as an asset. In the statement of financial position, that amount only, not the whole amount, the amount that is accrued only. Like for example, in this case, we have said that the accrued salary was 5,000. So the liability is only the 5,000 that is not yet paid. The amount that is in the trial balance is already paid, so it is not a liability. So if we had, for example, accrued income of 1,000, that 1,000 that is ours but not yet received, we treat it as an asset, a current asset, and this one a current liability. That is all about the accruals. Understand what they are? Amount not yet paid or received. If it is an amount not yet paid, it's an accrued expense. If it is an amount not yet received, it's an accrued income. What do you do with that? When you are preparing the income statement, you add that accrued amount to the amount given in the trial balance. When preparing the income statement. But when preparing the statement of financial position, that accrued expense or the accrued income should be treated as liability and asset respectively. When you are listing the liabilities, include that. When you are listing the current assets, include the accrued income. Period. You are sorted with the accruals. Unless there is a question before I move to the next end-year adjustment. But before I move, let me also tell you that when we are dealing with accruals, we have got many terms that can be used apart from accruals. Some questions, they call them outstanding. the synonyms. We can call them due, amount that is in arrears, amount that is unpaid, or not paid. So they can use any of these terms, but they mean the same thing as accrual. So we can talk about outstanding expense, accrued expense, expense due, expense in arrears, unpaid expense, expense not paid. They mean the same thing. So regardless of the term the question will use, just understand that they are all accruals. So don't be at a point whereby you say that Mwalimu never talked about outstanding. No. Outstanding, due, arrears, unpaid, not paid are all synonyms for accruals. Well, I think that is good enough. We go to the NDR adjustment number 2. Which is known as the prepayment. Prepayment. This is simply an amount paid or received in advance. Amount paid or received in advance before the due date. You have received that money before the time of receiving or paying that money has come. And actually, to make it simpler, it is an amount that you have paid or received this year, but it is going to be utilized the next year. You have received that or you have paid that amount this current year, but that amount is excess, and the excess is carried forward to the next financial year. That is where it is going to be utilized. The same way, you can pay your school fees and you pay in advance or as a prepayment. The extra amount that you pay, instead of being refunded, can be carried forward to the next semester where it will be utilized. That amount becomes a prepaid amount. The same case can happen when you receive. Remember, we are talking from the business point of view. A business can also receive some amount from the customers in advance. That is also a prepayment. Prepayments also, therefore, they are going to be of two categories. A, we have the prepaid expenses. The prepaid expenses, this is an expense amount that we have paid in advance. We have paid this year, but the extra amount will be utilized the next financial year. Think of a case whereby you are paying rent. For the whole year, maybe you pay a rent of 240,000 for the whole 12 months. But in that year, you have paid 250,000. The 10,000 that is on top of what was supposed to be paid becomes a prepaid expense. Then B, we have what we call the prepaid income or incomes. This is an amount that has been received in this current year, but it has been received in excess of what was supposed to be received. I can use the same illustration of rent. If we normally receive rent from our tenants, from the rental houses that we have, in a particular financial year, we were supposed to receive 100,000, but we received 105,000. The 5,000, which is on top of what was supposed to be received, becomes a prepaid income. And because now you have received and paid more, if I can come here, this is our example, whereby insurance is 9,000, and then you can be given an additional information. And the additional information says that this was one. Number two, it says that prepaid insurance amounted to 1,500. Prepaid insurance amounted to 1,500 from this 12 balance. So what are we supposed to do? Remember, what we received was 9,000 from insurance, but we have been told 1,500 is a prepayment. So the question is, when we are preparing the income statement, remember I've said, in the income statement, you use the exact amount that was supposed to be paid or received. Don't record more, don't record less. So this now 9,000, therefore, it is in excess. We cannot use it to prepare our income statement. So what we shall do, we shall have to adjust. We shall have to adjust the 9,000 and get the correct amount that was supposed to be received. So we are going to do this. We are going to take the 9,000 that was received, we minus the 1,500 that was prepaid, then we record that in that financial year, what we were supposed to receive was only 7,500. So the insurance expense for that year is 7,500. Is 7,500. Don't use this now. It is like the opposite of accruals. Accruals we were adding, but prepayments we less or we deduct because it is in excess. Now we deduct the excess so that we can remain with what was supposed to be received or paid this current financial year. So these ones, they are normally you deduct from trial balance figure. You deduct from the trial balance figure to get the correct amount. And then another case, how do you treat them in the statement of financial position? Prepayment. In the statement of financial position, remember I've said, we only deal with the three items, assets, capital, and liabilities. So you need to note whether these two items belong to assets, capital, or liabilities, and then you are going to capture them accordingly. So for prepaid expense, remember we have said it's an expense that we have paid in excess or in advance. Obviously, that amount therefore, because it is our money not utilized, it is going to be an asset to us. We have paid, but we have paid excess. That excess, it is like we are supposed to be refunded. So it is our money. It is an asset. For the prepaid income, we have received excess. And because we have received excess, we are the persons as the business to refund that money. So we have received more than what we are supposed to receive. The extra that we received, we owe the person or the institution that paid that money. So this one will be a liability. In the statement of financial position. In the income statement, we rest. But the amount that is now in excess, either excess paid or excess received, when we take the here, the statement of financial position, either it is going to be an asset or a liability. You argue. So if I pay the excess, is the excess a debt to me or an asset to me? It is an asset to you because it is your money not utilized. Where about this? A prepaid income, it is income received in excess of what I was supposed to receive. If I've received excess, then the excess is not my money. It is somebody's money. And when you have somebody's or a third party's amount, it becomes a liability to you. Yeah? That is how you argue that. So we shall be seeing how we deal with them when we get there. So the prepayments, sometimes you can find them being referred as the unexpired payment. Sometimes they can call them unexpired payments or payments made in advance for the sake of the exam question. So when you mix that, understand that they mean the same thing. So probably I can give you from what I shared. I can show you what I mean. Look here, there's a question. They normally come like this. The end year adjustments will always be captured as the additional information. So you are given the balances from the reg accounts for that period, and then they come here and give you the additional information. Number one talks about inventory. Remember, it says here that as at that 1st December, that is the last day of that financial year. As at that 1st December 2021, inventory was valued at 295,000. That is simply the closing inventory. And then number two, unexpired insurance. Unexpired insurance is the same as prepaid insurance, amounted to 30,000. So how do you deal with that? Remember the question was saying what? Let me go down. Prepare an income statement for the year ended. So you are told that insurance amount, unexpired insurance was 30,000. If you go to the balances extracted here, there is an insurance here of 140. And this unexpired means that there is a prepayment. So we overpaid by 30,000. Remember what is in the trial balance or in the balances is what you paid. So we paid 140,000, but out of the 140,000, 30,000 is extra. So when preparing the income statement, you'll have to minus or deduct this 30,000 from 140,000 so that you can get the insurance payable in that year, which will be 110,000. Roman 3 says that unpaid rent. Remember, any unpaid becomes an accrual. So rent that was paid was 80,000, and then here you are told that 20,000 is unpaid. So we paid 80,000 and we still have a balance of 20,000 that we have not paid. So how much were we supposed to pay? We said when it comes to accruals, you add. So that year we were supposed to pay rent of 100,000. For the accruals, you add. For the prepayments, you deduct. Then number 4, actual salaries. That was supposed to be accrued salaries, amounted to 140,000. Accrual, you are supposed to deduct that accrual from what was paid. And here you are told the rent, is it rent or what? Salaries. The salaries that we paid was 320,000. And then here you have been told the accrual is 140. So 140 has not been paid. Even if we paid 320, there is still 140,000 not yet paid, which we are supposed to add there to get 300 and what? Sorry, 460,000 rent expense. So that is what we do. We add. For the others, we have not captured. So that is how we deal with it. Good. I'm done with the prepayment.
Mwalimu, I haven't understood the actual salaries and how you've subtracted that one.
I've said that it was a typo error, a typographical error. It was supposed to be accrued, not actual.
Oh, okay.
Yeah. So number 3, adjustment will be on the depreciation. Depreciation.
Excuse me, sir.
Yes.
So what happens when the problem is a typo error in an examination? How is it handled? Because it confuses the student. Yeah.
Regardless on how you are going to treat it, if you look at it as actual and you treat it as actual, then it simply means that if the actual is 140, let me go back. If the actual, you treat it as actual, the way they have said, but here as you have the rent expense. Is it rent or salary? Salary is 320. Then they tell you actual. To me, I can interpret that we paid 320, but what was supposed to be paid is 140. Yeah? So that one now you treat it as you have a prepayment. Because the actual is 140, but we have paid what? 320. So we have paid excess. If you argue that way, if the actual is 140, remember what is in the trial balance is what you paid. You paid 320, but what was supposed to be paid is 140. Then the difference becomes the but what you record in the income statement then will be 140 only. Because in the income statement I've said we only record what was supposed to be paid, and what was supposed to be paid therefore should be the actual. So you see now, when you treat either way, you will get the full marks. You will get the full marks. But it's supposed to be accurate. Okay. Depreciation. In a business setup, we normally have these items we refer as assets. The assets are the resources that we use in running the business. Some of these assets are converted into income, that is inventory. We sell them, we get the income and all that. But when we are talking about depreciation, our focus is the assets we refer as the fixed, or we also call them the non-current assets. The fixed or the non-current assets. We talked about them when we were talking about the accounting equation and all that. We say the fixed assets are those resources that are owned by the business, and the business is going to make use of them for a long period of time. The assets that we acquire with no intention of selling them in the future. We are acquiring them with the only intention to use them to run the business smoothly. You acquire the computer to facilitate the smooth running of the business. You acquire the furniture to facilitate running of the business. You acquire the motor vehicles to assist in the delivery of goods and also something like that. So they are not meant for sale. And therefore, they have a long period of time in the business. These assets, they are the ones that undergo depreciation. And when we say depreciation, it simply means they undergo what we call loss of value. They lose value. They are going to be in the business for more than one financial year. They can even be in the business for 20 years. But what we need to remember, if they are going to serve the business for 20 years, the value will not be constant. As they are used from 1 year to the next, the value reduces. That value that they reduce every financial year is what we treat as a depreciation. So they will depreciate. I buy maybe a motor vehicle of 3M this year for running the business. After 1 year, my motor vehicle will not have the same value of 3M. It has lost some value. That value that it has lost, we treat it as a depreciation. You buy a computer. After using it for 1 year, the value will not be the same. The same case to furniture, the same case to equipment, the same case to machines. Those assets that are going to serve the business for a long period of time, they suffer depreciation. Briefly, we can talk about what causes depreciation. Causes of depreciation, number one, it is what we call the wear and tear. Loss in value due to the normal usage. This is due to the normal usage. Even if you are so careful on how you use your asset, as long as you are using it, it must undergo wear and tear. It will have to lose value automatically. That is one reason. Number two, it is about obsolescence. Some assets, they become obsolete as time goes by, and here we mean they become outdated due to changing technology. Yeah? As you use, remember they are going to be in the business for quite a number of years. As they are used in the business in those years, new and efficient models might come into the market. And therefore, we will be having an asset that is a bit outdated. It is not up to the current technology, and obviously the value will reduce. If you had acquired a typewriter, then later on, computers emerge. Computers are more efficient than the typewriter. So your typewriter automatically lose value. If you are to sell it, nobody will want to buy that typewriter. Everybody will want to buy the new equipment, which is the computer. Obsolescence. Number three, it is all about things to do with the rotting. This is normally affects the wooden, for the wooden assets. For the wooden assets. The wooden assets. Those wooden assets, if they are not properly stored and maintained, you leave them outside there where they are rained on and all that, they will rot. And as they rot, their value will reduce due to exposure to rain and something like that. Number 4, it is about rusting. This one affects the metallic assets. If you have your metallic assets, the equipment, the motor vehicle and all that, and then you don't oil them, you don't keep them safely, you leave them outside, they will last. As they last, they lose value. And lastly, number 5, it is all about depletion. This normally affects what we call the mineral assets. Depletion. So as we extract the minerals, the quantity reduces. As the quantity reduces, the value of the minerals that we had also reduces due to depletion. In the process of extraction, we deplete the minerals, therefore the value of the minerals that we had reduces. Those are the 5 causes of depreciation. The next thing now, after looking at the causes, is to understand when you are presented with a question and depreciation is part of it, how do you calculate depreciation? How do you calculate depreciation? Calculating depreciation. When calculating depreciation for examination purpose, we normally have 2 commonly used methods. You are going to be asked either to calculate depreciation using what we call the straight line method. Under straight line method, depreciation is constant or the years or the economic years. Depreciation is constant in all the economic years of that asset. Economic years, it is the number of years the asset will be used in the business. If it is going to be used for 5 years, depreciation per year, remember we need to calculate depreciation every year, every financial year. These statements that we have talked about here, the income statement and the statement of financial position, they are prepared yearly after 12 months. So after every 12 months, we calculate depreciation. So if we use the straight line method, depreciation for those 5 years the asset will be used in the business will be the same amount. If it lost 10,000 in year 1, year 2 will be 10,000, year 3 10,000, year 4 10,000, and year 5 10,000. Constant depreciation across the economic years of that particular asset. And the depreciation per annum, it is normally given by, you multiply by the percentage of depreciation which will be given times the cost of the asset. So if I had, for example, a furniture whose cost is 50,000, let me use 100,000. And then I'm told the depreciation is at the rate of 10% per annum. What that simply means, if I'm using the straight line method, in year 1, depreciation will be for 10% times 100,000 times the cost. The percentage is 10% times the cost. The cost is 100,000. So under that, I will get this one will be 10,000. 10% of that is that. When I go to year 2, my depreciation will be equal to 10% times 100,000 again, which is 10,000. Year 3, this is year 2. Year 3, depreciation will be 10% times 100,000, which still will be 10,000. So you can be able to see every year, because we are using the percentage and the same cost, the depreciation amount will not change. So if it had a cost of 100,000, so if it is losing 10,000 every year, then that furniture will serve the business for only 10 years. Because every year, if it loses 10, 10, 10, then it will just undergo or be used for 10 years, and the whole value of 100,000 will have depreciated to zero. That is what we need. Under the straight line method, first of all, understand depreciation is constant, and it is calculated as a percentage on the cost. The keyword there is cost, and the cost, it is the acquisition cost, the historical cost, the purchase cost. So every year, the percentage is the same, the cost is the same. So the answer for depreciation will also be the same. In some cases, you can find that depreciation is calculated as the cost minus the scrap value over the economic life, This is the number of years the business will be, or the asset will be used in the business. So, for example, if you are told that this asset was acquired at a cost of 100,000, you are told the life, the number of years it is going to be used, probably it is 8 years. And then after the 8 years, it will have what we call scrap. Sometimes we call this one salvage. Sometimes we call it residual value. The scrap value is the same as the salvage or the residual value, and it is the remaining value of the asset after the asset has served the business in its economic life. After being used for 8 years, will that asset have the remaining value? If yes, that remaining value becomes the salvage or the residual value. So maybe we are given the scrap value, in this case is 20,000. The question is, then how much does this asset depreciate per annum? Then it will be equal to the cost. Remember, we bought it for 100,000. After serving us for 8 years, it will maybe be 20,000. Up to that point, we can be able to see or to interpret this. This is the cost, this is the remaining value after 8 years. Then if we minus these two figures, then it simply means we are going to get how much it lost. We started with a value of 100,000, we ended up with a value of 20,000. The difference between the two, it is the value lost to depreciation, and that value lost to depreciation we divide by the number of years, so that every year can take in the equal portion. We started with 100,000. It has served us for 8 years. After serving us for 8 years, it is remaining with 20,000. Then it simply means that 100 minus 20,000, it is the total value lost, which is 80,000. This 80,000 has been lost in 8 years. So every year should take the equal portion. That's why we are dividing by 8. Then we find that it is going to have a depreciation of 100 or 10,000 per annum per year. So 10,000 in year 1, 10,000 in year 2, up to year 8, it will give us the 80,000 year. So that is how we can also calculate it. But for the examination purpose, in most cases, you will be told that depreciation on a particular asset, it is a particular percentage on cost. The moment they say it's on cost, just know that we are using the straight line method. In other cases, they can tell you 10% on straight line. If they tell you 10% on straight line, just know that we are supposed to multiply by the cost. So either way, you need to have a very good understanding over the same. That is the first method of determining depreciation that we're supposed to use. And before I go far, the depreciated amount, every year, the amount that you calculate and you say that this is the depreciation, that amount should be treated as an expense. It should go. So if it is 10,000 in year one, so in year one, when we are listing the expenses, we shall capture their depreciation on furniture, 10,000. It is going to be treated as an expense. And also remember, depreciation is a provision. Depreciation is a provision or it is an estimated amount. And that amount, it is not a cash expense. We treat it as an expense, but it is not a cash expense. Meaning, there will be no cash outflow. There is nobody that we are going to pay and tell the person that this is the 10,000 for depreciation this year. Nobody will be paid that much, but it is just being realistic. We look at our computer, we bought it at 30,000. This computer has been used to generate income, but it has lost value. So if I say that I received or I earned a profit of 50,000, but the computer that was part of the equipment that used to generate that revenue or profit has reduced or lost a value of 4,000. It is realistic if then we can be able to adjust our profit. In the process of generating this profit, our assets suffered. So the real profit will be 50,000 minus the depreciation that was incurred. Because when we are generating profit, our equipment, our assets are reducing value. So the value that is lost in generating this income, we should be able to reduce the profit so that we can be realistic. So that we cannot celebrate that we are making a lot of profit, whereas we are not providing for the depreciation on the assets that are generating that. And also, it is very prudent. These assets, because they have economic life, they have a lifespan. If you don't provide for depreciation, this asset was supposed to serve you for 10 years. Then after the 10th year, you need to replace and buy a new one. If you don't provide for depreciation, then you will not have funds to be used to acquire the new asset when the asset has fully depreciated and it has no economic benefit to the business. So we provide so that that money can be set aside. When the asset is no longer economical to be used, we can use the money that we have been providing to acquire new machines, and the business will continue running. So that we don't celebrate that we have made a lot of profit without providing for the provision. So provision simply means it is an estimate. And this estimated amount, it is like it is set aside from the profit to be used to acquire new machines when the existing machines will not be having any economic benefit to the business. That is it. That is it. So, flip side method. Depreciation is constant every year. Either you take the amount depreciated, then you divide by the number of years, or in the common exam scenarios, you are given a percentage, and then you are told it is depreciated at this percentage on cost, or it depreciates at this percentage on straight line. Multiply by the cost, you will get the depreciation for that financial year for that specific asset. Good. We go to the second method. The second method, commonly used in exam question to calculate depreciation, is known as the reduced balance, reducing or diminishing balance method. The reducing or diminishing balance method. In this method, depreciation is not constant. Depreciation is not constant or fixed, as we have discussed in the other method straight line. In this method, depreciation keep on reducing or keep on diminishing as the years goes by. So the depreciation amount for any fixed asset will be more when the asset is new, and then as it is being used in the business, then its value reduces. As its value reduces, its depreciation amount also keep reducing. So depreciation reduces, and when the asset is new, that is when it is used more. That is the assumption. When the asset is new, that is when it is used more. And when it is used more, it depreciates more. As it gets older, it is less used. As it is less used, it is going to be less depreciated, like that. So under this method, depreciation will be a certain depreciation rate in percentage. You multiply by what you call the net book value, NBV. So we don't multiply by the costs. We multiply by the net book value, where NBV is normally given by cost minus accumulated depreciation. Cost minus accumulated depreciation gives you the NBV, net book value. Then that net book value we multiply by the percentage. If I go back to the example that we had on the furniture had a cost of 100,000. Depreciation, we were told, is 10% per annum, like that. If we were to use the reducing balance method, the depreciation, for example, for the past 3 years, whereby we can have a table year 1, 2, 3, then we have the depreciation amount, then we need to be determining the net book value after every year, like that. So year 1, the depreciation will be 10% times 100,000 because the asset is new. It has never depreciated again. You'll get that it is going to be 10,000. So what is the net book value after year 1? We started with 100,000. It has lost 10,000. The remaining value, which is the same as the net book value, is 90,000. The net book value is simply the remaining value after deducting the total depreciation from an asset. So when we go to year 2, the depreciation will be 10% times now 90,000. You multiply it times the net book value, which will be equal to what? 9,000. Remember, after year 1, it had a value of 90,000. Year 2, it has lost another 9,000. So the net book value, the new net book value will be the 90,000, the value at the end of year 1, minus the depreciation at year 2. You get this one will give you 81,000. When you go to year 3, depreciation will be 10% times 81,000, which will give you 8,100. So the net book value will be 81,000 minus 8,100. You get that. That is how we do it under reducing balance method. Depreciation is not constant. Depreciation keep on reducing. And if it keeps on reducing, because also the net book value keeps on reducing. If the net book value keeps on reducing, the depreciation reduces. Remember, year 1 it was 10,000, year 2 9,000, year 3 81,000. So it is diminishing. Diminishing because even the net book value is diminishing, and we are calculating depreciation on our net book value, the cost minus the accumulated depreciation. So that is how we do it. So when a question is presented in this method, you will be told, you will be given the trial balance, something like this. You will be told there is a motor vehicle, and maybe the motor vehicle is an asset. Maybe it is 200,000 for the station. They will give you that. And then on the same note, they will also provide or give you accumulated depreciation on motor vehicle. They will give you this one, all the provisions or estimated amounts they are normally credited. You will be told maybe it is 20,000, all the provisions. Meaning that before the beginning of this year, it had already lost 20,000. We bought this motor vehicle at 200,000, but by the start of this year, already 20,000 had been depreciated because the business is not starting yet. The business is a continuation from the previous periods. So from the previous period, we had already lost this. And then you will be told now, depreciation on motor vehicle is what? Maybe 20% per annum on reducing balance. They will tell you like that. It is 20% per annum on reducing balance. So for you to be able to get the depreciation amount for this year, you will take 20%, you multiply by the net book value. The net book value in this case we have said is what? Cost minus accumulated depreciation. You use this 200,000 minus 20,000. You get this one will be 20% times 180,000. And then you find that this one will be a figure of about 6,000. That is it. But if you are told that the depreciation is 20% on cost, if they had said on cost and not this, we could have simply taken 20% times 200,000. If we are told it's on cost, we don't bother deducting this. We treat it as on straight line. But when we are told it is on reducing, obviously they will give you the cost and the provision for depreciation or accumulated depreciation. So you have a responsibility of deducting this before you multiply by the rate of depreciation. Like that. So that is the difference. The other one is on cost, the other one is on net book value. If it's on cost, just multiply by the cost given. If it is on net book value, take the cost, deduct this to get the net book value, then multiply by the percentage of depreciation given in the question, whether it is 10%, 12%, 15%, and all that. That is all about the depreciation. So, depreciation in the income statement, the amount that you get, you treat it as an expense. When you are listing your expenses, salaries, insurance, repairs, electricity, include depreciation of that asset. You include it part of the expenses, the one that you have calculated. Then to the statement of financial position. Remember the statement of financial position, we want to know the exact value of assets, capital, and liabilities at the end of every financial year. So when you have, for example, the motor vehicle, which is an asset, and you want to know its value in the statement of financial position will not be this. You just take 200,000, you minus the depreciation for the previous periods, you minus the depreciation for this period, that's 6,000. This was lost in the previous year. This is what has been lost this year. So this plus this is what we call accumulated depreciation. You minus from this, you will get the net book value. So in the statement of financial position, we want to know the exact values of our assets. So if there is any asset that undergoes depreciation, we deduct all the depreciation to get the net book value. But in the income statement, the depreciation calculated is considered as an expense. We shall do examples, don't worry. The last end year adjustment is what we call bad debts and provision for doubtful. Bad debts and provision for doubtful debts. So for the case of bad debts, these are unrecoverable. The unrecoverable debts. And they arise as a result of credit sales. The credit sales, they create people we call the debtors. When you sell goods on credit to your customers, those customers who buy those goods are regarded as debtors. They are regarded as debtors. So some of those debtors might never pay you. And when they never pay you and you have confirmed that they will never pay you, you treat those amounts as bad debts. The amount that you may never recover from your debtors, either by bad luck, the debtor passed on. You cannot keep waiting for that money because it will never come. You write it off as a bad debt. The debtor can never be traced. 2 years down the line now, you cannot continue waiting for that money. Write it off, remove it from your books. The debtor, you have heard that probably is bankrupt. He has certificate of bankruptcy. So he's legally protected from any person or any creditor. So that amount that you have no reason to believe that will be recovered, you write it off, you remove it. And when you remove it now, you are going to consider that as bad debt written off. These ones will be treated as will be considered to be expense. Any amount that you write off as a bad debt, it becomes a business expense. It is the amount of money that you have lost. So in that financial year, if I have considered that maybe probably 2 of my customers are bad debtors, and the total amount that I was expecting from them was maybe 5,000, then this 5,000, when I'm considering the expenses for that year, I will also treat that as an expense. So when I'm writing the expenses for the year, electricity, the amount of money I spent for salaries and wages, I'm also going to consider bad debt written off 5,000 to be among that. I hope for the bad debts it is very clear. And if you had the debtors, you know you had got the total debtors. The debtors, probably they were 30,000 for that year. Then you have considered that 5,000 is bad debt. So the debtors would be, you take the 30,000 that you're expecting, you minus the 5,000, which will never be recovered, you will remain with what? 25,000. You remain with it. This is what now you record as debtors. Remember, debtors is a current asset. This is a current asset. So when you are listing your current assets, debtors, don't use 30,000. Use now the realistic amount that you are sure of receiving. The 5,000, take it as an expense, then adjust the debtors downwards to deduct that amount. That is it. Then there is what we call provision for doubtful debts. Provision for doubtful debts. Any question on bad debts?
Yes, teacher, I missed the part. What was the 5,000 for?
Sorry?
The 5,000, what did you say it was?
That one is what you have considered to be bad debt. Maybe that person who was supposed to pay you the 5,000 died. What do? He was among the people who you are talking about. So you deduct the 5,000, the debtors will be 25,000, and then this 5,000, I've said you are going to treat it as what? As an expense. Is it okay?
Yes.
So that is it. Then provision for doubtful debts. When we talk about a provision is simply an estimate. A provision is simply an estimate. An estimate, it is what might not be recovered from your customers. This normally occurs when the business has operated for a considerable number of years. You have a lot of experience. You have run your business for more than 10 years. And from now experience, you know that every year, probably 2% of debtors, 2% of debtors never pay for that year. So what you normally do, you do a provision. You do a provision. A provision is like setting aside some amount of money. Instead, in case they don't pay, that provision can be able to be used to cover that. So I want you to pay very keen attention on how we treat the provisions. Just a minute. So the provision is what you estimate at the start of the year that you will never recover at the end of the year. And then you find that, I want you to understand, we are going to have 3 scenarios on how we treat this provision. When it is a new provision, when you are doing the provision for the first time, you say that 2% of the debtors will be bad debts. So in that new provision, which is now going to be a provision in the year 1, and the debtors in that year 1, they amounted to 30,000. So what are you going to do? You are going to come here and do 2% times 30,000. When it is a new, you take the percentage of doubtful debts times the debtors. So what you are expecting not to be recovered will be what? 600 that year. So in that year, what will be recording as debtors will be 30,000 that you are expecting minus 600 that is doubtful. You are going to only record what? 29,400. That is the year 1. And then the whole of this 600, you go and deal with it as an expense. The whole of 600,000, deal with it as an expense. So let it be among your expenses. Then you go to the year 2. You'll find that the debtors amount for year 2 was 50,000. You will have to calculate another provision. The provision would be equal to 2/100 times 50,000. This is 1,000. Note now here. For the debtors now, what you record, it is the 50,000 that you're expecting minus 1,000, which will be 49,000. That is what you record as debtors, which is part of the current asset. But what are you going to deal with as an expense? The expense here now, you don't deal with the whole amount that you have provided. So you compare, year 1, the provision was 600. Year 2, the provision is 1,000. You only deal with the increase only, which is going to be what? From 600 to 1,000, it is only an increase of what? 400. It is only an increase of 400. So this 400,000 400, sorry, is what you are going to consider as an expense. 400 is what you treat as an expense, not it. So in the first year, the whole provision is an expense. But in the subsequent years, the expense amount will only be the amount by which the provision has increased from the previous. So if I go to year 3, I find that the debtors are how much? 55,000. Then the provision will be 2% of 55,000. That and that. This will be 110, will be 1,100. Remember, in the previous year, the provision was 1,000. This year, the provision has gone to 1,100. So the expense will be from 1,000 to 1,100. It is only 100. You deal with only the increase. You deal with only the increase. But also, sometimes the provision can decrease instead of increasing. Maybe in year 4, the debtors, it is now 48,000. It is not increasing to 55. And then the provision will be equal to 2 over 100 times 48,000, which gives you what? This is going to be 960. Remember, in the previous period, it was 1,100. Year 3. Year 4, now it is 960. It has reduced by what? 140. Means a decrease of 140. This decrease, when it is a decrease, you now treat it as an income. When it is a decrease, the decrease only, which is 140, should be considered as a business income. So let me repeat now from the start. When it is at the first provision, the whole provided amount, take it as an expense. The debtors you deduct that amount. But in the subsequent years, what you treat as an expense or income will either be the increase. If it is an increase, an expense. If it is a decrease, you treat it as an income. But the provided amount, the provision, you must deduct it from the debtors every year. Even here, we are supposed to deduct the first 60, we are supposed to minus from this to get the debtors balance to be recorded in the statement of financial position every year. So I want you to be very keen on that provision. But the good thing, this is just the explanation. In our next class, we shall now apply practically on the questions of financial statements and see how we are going to deal with that. So if there is no question, I wish to stop there. But if there is, you are free to ask.
I have a question, teacher.
Not regarding the topic,
Yes.
but the new students like me who are just joining, I'm just asking if all the sessions were recorded and shared on LMS or there's any other way we can catch up.
Yes, we have some videos on the LMS, but they are not for this class. This have also been recorded. Actually, I don't think there's a class that we have not recorded. So what I'll do, because I have the recordings, I will be sharing those recordings afresh from the first session. But we have similar recordings on the LMS, which are also helpful. But those recordings, you will find that every group, I normally use different questions, but in the same topic. So they are also helpful, but for this specific group, the recordings are there, but they are not the ones that are on LMS that I will be updating in due course. But I've been sharing them on
Should I
the,
reach out separately or you'll share them?
In the WhatsApp group.
it is normally shared on the WhatsApp group.
Okay.
So the ones that are on there, you they supplement with the notes that are on the LMS.
Yeah.
Because I normally issue new questions. Once I have solved them here, I now share the recordings on WhatsApp.
And do we have
Maybe I saw something like we have maybe groups within. Have we done any assignments?
Not
So
yet.
far? Okay.
We are waiting for people like you.
Okay.
Yes, this unit we normally have some group discussions, but
Okay.
I will not have the group because I know we still have new members joining us.
Yeah.
So
Yeah.
probably towards the end of this month, I will be forming the groups, share the questions, then we can
Okay.
be discussing them in a class forum.
Okay. Thank you.
Okay, you're welcome. Any other question?
I wanted to know exactly, does this class begin at 6:15 or 6:30?
I normally begin at 6:15.
Oh, because I've been assuming others begin at 6:30, so maybe that's why anytime I log in, I find I'm late. Sorry for that. Okay.
Now you know. This one is a bit range in some cases. I might not be able to finish some questions if I start at 6 now. And also for those who are joining, remember also we have Sunday class, 4 p.m. Maureen, for your information. 4 p.m. we shall be having the financial statements of a sole trader, whereby we shall be applying all that we have discussed here when preparing the income statement and the statement of financial position for a business that is owned by a single person, the sole trade. So also purpose. I hope you are also on the WhatsApp groups.
the Sunday class is at what time?
It's 4 p.m.
4 p.m. Okay.
Yes. You find the link on the LMS. Where you found the link today, that is where the link will always be shared. It will be updated with the date for that particular class. I think that is good enough. If there is no other question, we can stop there. So bye-bye. Enjoy your day.
Thank you, Madam. Have a good day. Bye, teacher. Good day.
Thank you. Good day. Bye-bye.
Kindly share the recording.
Okay.